So one of the questions I hear often is business owners asking if they can have one of their companies rent out real estate space from another one of their companies. And usually when they ask it, it's more of a whisper and a side eye, like the feds are listening. Well, don't worry about it. It's actually not illegal. All right, it's actually done quite often, and it's referred to as a synthetic lease. So in this video, we will discuss what a synthetic lease is and how it is used. So let's get right into it. Now, how can we pay ourselves and ultimately pay less in taxes because of it? More importantly, how is it even legal? Well, synthetic leases is the key. Now, this lease structure was originally created to help companies improve their balance sheets, right? Their debt to equity ratio. Essentially saying, how can I control real estate and own it, but not have the mortgage count against me? Or in other words, how can I show that my company is more profitable and still get the tax benefits of real estate? It does sound fishy, I'm sure, but it's not. It's 100% legal and abides by all the US tax laws. So how does this work? Well, let's say that I have two different companies. Now, my first company is my primary company who needs a new office space, but it still wants to show a more profitable balance sheet. So I create the second company as a special purpose entity, or SPE for short, to purchase the real estate. So let's say it's Mike Enterprises, that's the primary company, and we create the SPE as Mike's real estate company, for example. So in this scenario, Mike Enterprises needs a building to rent. So after we create the SPE, Mike's real estate company, then Mike's real estate company purchases a building and leases it back to Mike Enterprises. That's it. You now completed a synthetic lease. Now, the question is, why does this work? And this is where it starts to get fun, right? Since the SPE owns the real estate, it gets to take full depreciation benefits of the actual property. And it only really counts the income from the lease in their profit and loss statement. However, the main company only shows the operational lease as an expense item. It does not count the full debt of the mortgage on its balance sheets. Now, this helps that company show itself as being more profitable in the long run. Now, this is primarily a function of financial accounting and nothing more. But you can easily begin to see some of the benefits of using this creative strategy amongst business owners. Matter of fact, let's talk about when it might be the right time for you to consider something like this as well. First, you need to take a look at your business and see if it's even necessary to do one of two things. Either one, show a higher balance sheet, or two, own real estate for your company. And if you don't know, then there's two different perspectives that you can look at it from. Number one is the company being sold or marketed to raise capital? And if that's the case, then it may do you justice showing a higher balance sheet, because that could have the investors see a higher potential in your company's performance. And number two is, does the company need additional liability protection? Meaning, if you have additional exposure, do we need a separate entity, an SPE or an LLC, to help mitigate or separate that liability even further? If the answer is yes to either of those, then you may want to consider a synthetic lease. This is just scratching the surface on creative applications for legal and financial strategies for your business. Now, if you want to hear about this strategy in more depth, then go ahead and leave a comment below, and I'll make sure to make another video. Now, if you found this video useful, be sure to share it with all your friends and tell all of them to hit the subscribe and the notification bell so they don't miss any new videos. And go ahead and smash that like button as well. As always, thank you for watching, and I'll see you in the next video.